Hey everybody, welcome to the channel. So this is going to be a channel that is going to be focused on my dividend growth focused portfolio that I've built starting on February of this year, 2021. And I mainly just wanted to do this because I wanted to start another source of passive income in my life, so I don't need to work every single hour actively at my job to make an income. So I went with a dividend focused strategy over indexing or growth focused strategy, mainly just because you can't really control the market. Like the prices of your holdings can go up and down any which way. You're not really in control of that at all. So rather than worry about the daily fluctuations of all my stocks, I'd rather just hold on to them and hang on to them and extract value from them in the form of dividends. So that way you're getting cash flow that you can reinvest either back into the holding or a new holding, and you don't lose any ownership of the company that you own, because the only way to get a return on a growth stock that does not pay a dividend is to sell out your shares. But what if you don't want to sell it? Well, once you sell it, yeah, you make a profit, but then you lose all equity in the company. With a dividend, that's not the case. You still maintain all your ownership of the company. They can increase their dividends. They can buy back stock shares as well, so they can also improve your return over time. So just going to go over my holdings here on this spreadsheet that I made just to track my dividends. So I'm tracking how much I've earned. So we've earned over $100 in dividends. It's taken us about, maybe 6 months to hit the $100. And by my calculations, I should be able to hit the next $100 in about 3.5 months. So that'll be about half the time. So that's another benefit to the strategy, is that just psychologically knowing that I'm going to be earning an amount of money, that money gets reinvested in the portfolio, and I can regain that amount of money much quicker than the original time. So that's just the snowball effect of dividend investing, which is why I've chosen it as a strategy. Especially if we head into a down market, all your holdings go down, you're going to have your assets producing something for you. So it's going to be a lot less stressful, so that it gives you a big psychological benefit. And we make $370.88 annually from our dividends, which comes out to $30.91 per year. So I'm just going to go through the holdings just lightly. So I have Algonquin Power and Utilities, so just stable utility company with 1/3 of the business in renewables, so they pay a healthy dividend, and they also raise it as well over time. So good growth potential with this one. I have 2 Canadian banks. I have Scotiabank and TD. Mainly Scotia pays the highest dividend. TD has the highest dividend growth rate of all the Canadian banks, and they cover different regions. So TD has more American exposure, Scotiabank has more Latin Americas, so that's why I have a split like that. I have Power Corp. They're just a holdings company, so they own a big stake of Wealthsimple. I really, really like this company. They're also invested in an EV company, life insurance companies, financial asset management, and I think they have a lot of growth potential, which is kind of surprising from a blue chip, pretty stable stock. The next one needs no introduction. This is Apple. So this one has given me the highest return, at least from the share price, just because when I bought it, the PE ratio was like 24 and the market was like over 25, and it just made no sense to me. Like, Apple is an above average company, on the market. It's arguably the best company on the market. It is the most valuable company on the market and the most valuable brand in the world. And they really just have this big moat that they set up, a walled garden. So, you get one Apple product, you're encouraged to get more. They are growing their, services revenue. Like, they're becoming a fitness company. They're becoming a music company, an entertainment company with Apple TV. And they're just growing their revenues every single month, which is great. And it's more reliable revenue than, just selling iPhones. But even those sales have gone up a lot this year. The next one is Alimentation Couche-Tard. So this one is going to be a convenience store / gas station. So you might know these as Circle K's and and Essos if you're from North America. And so this is a really good business. They have 14,000 convenience stores all over the world. And they're also kind of set up for the EV sector, just blowing up, just because their fuel stations can be converted to charging stations. And they've already have that underway in Norway, because Norway has a law in place. By 2025, they won't be able to sell any more internal combustion engine vehicles after 2025. So like half the vehicles in Norway are already EVs. And I think that's just going to play into Alimentation Couche-Tard's hand, because if you're charging your car for 10-15 minutes rather than filling up for a minute, you're going to spend a lot more time in the convenience store. You're going to be spending more money, and of course they're going to get a cut of the profits from you charging your vehicle. So very good future prospects. CNR, I bought because of the acquisition they're trying to make with Kansas City Southern. So essentially, if they do buy them, they are expected to, but if they don't, I think the stock will rebound, because it mainly went down from the 150 range to 130 because people think that they're paying a premium for it. And while that may be true, you can't really expand a railroad just due to the regulations. It's very difficult to build any more infrastructure. So the only way to really grow your railway company is through an acquisition. And I think CNR knows this, and if they do actually get it, they're going to own railways going from Canada, US, and Mexico, which is amazing. I think they will just be dominant. They'll be able to control pricing very effectively, and they won't need to switch over from different railway networks. They can just seamlessly control every part of their logistic chain, which is just great for the future. If the deal doesn't go through, say it doesn't happen, I think the stock will shoot it to 150. I'll probably get out of the position at that point, because I only want it if they have this acquisition, because I think that is the best for their long-term future. And next is going to be TELUS. It's going to be another, basically a monopoly. So there's only 3 telecoms in Canada. Foreign competition's never allowed. I think Verizon tried to get into the the Canadian market, and it just never happened. So they have the best dividend growth out of all the 3 telecoms, and they're growing their revenues while Bell and Rogers are pretty stagnant, and they're not as diversified as TELUS is with their agriculture and healthcare investments. The next, I have 4 REITs. So I have Granite REIT. So this is my industrial and so e-commerce and EV sector play. So I think this is going to grow a lot over time. So we have a fair bit of investment in here. The next is smart centers. So think your Walmarts, and then they fill up these plazas with a lot of foot traffic, and they rent out to smaller shops, because Walmarts attract a lot of foot traffic. And they're also starting to dabble into industrial and residential to diversify their portfolio a little bit more, because the pandemic has hit retail, but luckily Walmart is an essential service, so they haven't been hit as hard as other REITs, and they have not cut their dividends. So that's another plus for me, just because we don't want our income to decrease over time. We want it to go up. So that's a great sign for them. Northwest Healthcare is just going to be our really safe, really boring hospital REIT, clinics all over the world, and they have really long leases, and they have increases built into those agreements. So pretty safe, pretty boring. Slate Grocery is going to be our grocery stores that are all in the United States. So these are probably the most reliable tenants you can think of. Our yield on cost on this one is over 9%. So that's just fantastic. And then we have some heavy income focused funds. So eSplit is basically just another way to own Enbridge. So this is a company that they use leverage, they use call options, and they only own Enbridge stock. And the benefit of owning this versus Enbridge directly is, number one, 11% dividend versus like 7, and this one pays monthly, not quarterly. So it's going to be hitting your cash account. You're going to be more ready to pounce on deals, or just compounding ENS or your other dividend holdings. Dividend 15, similar idea, but instead of just one company, this is 15 blue chips in Canada. So think your Canadian banks, your telecoms, your Manulife financials, other blue chips like that. And they use leverage and call options as well to make lots of income. The next one is Canoe EIT. So this is just a solid one that have been paying a very reliable over 10% dividend for over a decade, never missed a payment, and they have a lot of blue chips from Canada and the US, and they cycle them out from time to time. So I guess they're just looking for good deals from time to time, and so this is a really good fund, very reliable payout. So really like this one. The next one is a TXF. So this is a technology-focused ETF. So essentially, your Googles, your Netflixes, your Amazons, who don't pay dividends, but one nice thing with this one is there's a lot of capital appreciation with this fund. Usually with income funds, that's not something you get, but with this one you do. So you get growth, you get a good dividend, you kind of get a bit of everything here while still investing in the technology sector. So that's just a fantastic fund. I really like this one. And the last one is HHL. So this one is going to be a healthcare ETF. So think your Johnson & Johnson's, your Pfizer's, and there's just no way to really get into the healthcare space in Canada. We just don't have these these companies to invest in. So that's why I went with Tech ETF and HHL, and that's also why I invested in Apple, because there's just nothing like these companies or these sectors in Canada to choose from. So, when there's nothing in your home court or your local area or your local country to invest in, definitely look elsewhere. And we also have a little dividend growth tracker here. So you can see the first month I made $18. April and May we didn't make very much, just because a lot of companies pay quarterly. And we didn't have much invested. I started with like $500 in this account. So one thing you want to do is just be consistent. Just start investing. That's going to be the thing that I'd say I learned from this. Just make it a habit. Just deposit what you can, every week, every month, whatever you can, and just start like that. Once it's a habit, it's going to be really, really hard to break that habit. And you're going to be seeing your dividends grow. So like in June, we hit 34, which is our highest month ever, and then 27 in July and 17 in August. But again, you can see that they've grown a lot from April and May. So we won't be getting any more months where we're making $8 or $9. The new low is going to be 17, with a high of like probably 35 going to for the next month. And another thing I hit was a milestone, was to hit like $1 a day from the portfolio, which we've done. So I've accomplished that. The next goal will be to try to make $2 a day, and so on and so forth, because investing is a really long journey. It's really easy to get discouraged, and I think these goals and celebrating your little milestones as you get there, so earning $100 in dividends is pretty great. I even celebrated getting my first dividend, which was from Enbridge, actually. So just, celebrate your victories, because you're going to be in it for the long haul. And just remember that if you're dividend investing, don't focus so much on the current value, because this number can go down at any time. We can be up 600, we can be down 600. The point is that we're going to stay invested, and if the market's down, it's actually a good thing. That's something I've learned as well, because since I'm not really making my money from selling my shares, I'm just holding on to them and gaining a dividend each and every month. I just want what the shares can provide me. I'm not looking to sell my assets. So just think of it like you're renting a property, right? And you're just getting rent. You're not concerned with the daily value of your property, as long as it's providing you value and cash flow. All right, so that's everything. Don't forget to like and subscribe to the channel. And if you haven't already, you can sign up for Wealthsimple using my link in the description. So you can get the value of up to 2 free stocks. And it's just going to give you the cash value. It won't give you the stock. So it could be a good start to your portfolio and your own journey. All right, have a good day.